Coming up on today's show, Trump's officially in office and where you need to be positioned for his presidency. Apple's iPhone sales could fall as much as 18%. Trump's $500 billion AI plan, and why this chart is the only chart you need to be looking at for 2025. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks traded in the green on Tuesday as investors digested President Donald Trump's first day in office and his first policy moves with promised tariffs in Mexico and Canada front of mind. And despite all of the volatility we saw in the dollar, US stocks opened this week in the green, led by the mega caps, and that was because there was some news from Trump's administration saying they're planning on a $500 AI infrastructure build-out. Oracle was named as one of the big hitters, so too was OpenAI, but let's be honest, it's going to benefit the entire tech space. Nvidia will get a piece of that pie, same too with AVGO. All of these names right here, AMD, GE, Qualcomm, Cisco, all of the hardware names and all of the software names rallied on the back of that, as well as the earnings upcoming. The only laggard in this entire industry was Apple. They were down 3%. We're going to talk about why a little later on in the video. Apart from Apple, Tesla, as well as energy, it was green across the board. Guys, very, very strong returns from stuff like retail. If we look at healthcare, manufacturing, consumer services, utilities, cyclicals, defensives, sensitive sectors, all rally except for energy. XLE was down 0.67%. To be honest, after the run that energy's had to kick off this year, taking a bit of a breather to be expected. However, every other sector was positive today. The SPY returned 0.81%, but we saw everything from XLP, XLY to XLU rally. Yields fell, and that's why we also saw rate-sensitive sectors do very well. Stuff like utilities, industrials, real estate, healthcare. These are sectors that use a lot of debt, have a lot of debt. They're insanely sensitive to rates. Rates have been falling. The dollar did retreat on the weekend. There was a lot of volatility while the markets were closed. We're going to talk about that, and that is why these rate-sensitive sectors were up 1.5, 1.8, 1.87, and 2% for utilities. But we saw materials was up 1.16%. XLC, the communication services sector, was up 1%. In fact, of the 11 sectors, 6 of them gained more than 1% today. Technology just shy of 1%, but the other sectors, XLY, XLP, XLF, financials weighing on the SPY, but that's really going to say the bullish day we had today, because when you have positive sectors weighing on the SPY, because these were so immensely bullish, it really goes to show the type of day we've had today. But however, this is the S&P 500 sectors. It was bullish across the board, particularly here in the small size. In fact, the small size outperformed the large component of the market. See small core, small growth, mid-cap growth, the mid-cap core really exceeded expectations. Very, very bullish. But that's not to say the rest of the market wasn't bullish. Small cap value was bullish. Mid cap value was bullish. And the large cap space as a whole was also very bullish. It's just that this part of the market right here was more so bullish than the other parts of the market. You love to see that. I feel like a lot of people have been positioned in this part of the market. And I've been champion saying, hey, you want to be positioned in small caps, mid caps, in this component of the market, because I think it'll outperform, and we really are seeing that outperformance take shape. Now guys, there was a lot of movement with the US dollar and tariffs today, and this heat map can give us an indication of how the market is gauging Donald Trump's economic tariffs, right? So we can see that the US, this is us, the US kind of green, Canada was ever more so green, and Europe was very, very green. And that's because Trump didn't do tariffs on his first day in office. The market was pricing that in, and that's a little bit of a relief. But what we saw was South America here kind of taking it on the red, as well as most of Asia. So a lot of the tariffs that will be implemented are seeing as severely negative for South America and Asia, and a little bit more on the positive side here for Canada, parts of South America, as well as Europe, Australasia, and then this part of Southeast Asia right here, the semiconductor belt of the world. Now, it really goes to show how the US dollar and how tariffs are going to impact those countries and those geographies for 2025. So if you really want to be positioned outside of the US, really look at maybe this part of Southeast Asia, Europe as well, and maybe Australia, because that's really where tariffs are probably going to have the least impact, but there will still be tariffs nonetheless. Now, let's actually go ahead and talk about earnings. We had a slew of earnings today. Now, 3M helping the Dow Jones move up more than 1% today. This is on the back of solid earnings. They beat top line and bottom line and issued very optimistic full year guidance. We also got earnings from Schwab. They jumped on again a double beat, and the brokerage raked in $115 billion worth of new assets in the last quarter. Schwab was up 5% on the back of this news. Now, D.R. Horton's stock wavered on Tuesday morning after the builder reported weaker than expected home orders for the fiscal first quarter, but affirmed its full year guidance and delivery projections. Now, higher mortgage rates are leading to increased incentive levels, and the use of incentives is weighing on margins, and that's why it actually missed on the margin side. The stock was down 1.25%, but still reaffirmed guidance, and that's why the stock was up a little bit right here. But you can see the market pairing those gains as a result, closing lower on the day. Nonetheless, so far, when we actually look at this earnings season, if your company is beating earnings, we are seeing a 3.34% beat so far for this earnings season. This compares to the historical average of 1.5%. In other words, if your stock is beating the analysts' estimates, you're seeing outsized returns relative to the historical average. And that just goes to show when sentiment is not that great, earnings can be a huge catalyst for us to go higher. And then in other market movers, the big one we saw today, guys, was Apple. They were down 3.86%. The stock nearly fell 4% as we saw a slew of Wall Street downgrades. There was like 8 or 9 Wall Street downgrades on the back of some reports from China that saw iPhone sales demand fall as much as 18% in the fourth quarter. This is not what you want to see from a company like Apple, which trades at a 40 PE multiple and has been priced to perfection and beyond. And that is why Apple was down 3% today. It's about 13 or 14% off its highs, nearly 245, nearly 250 level. And reports like this simply do not help the iPhone manufacturer. But when it's all said and done, guys, the market was very bullish today. We've recaptured nearly all of our moving averages except the 50-day moving average right here. But our shorter term moving average is acting really well. The medium term mixed, but the 100-day looking good, and then these longer term moving averages, the 150, 200-day in very green territory, well above the 50% line. This is exactly what you want to see coming off the lows. You want to see a huge sharp bounce and move higher on strong volume. We saw that volume come in, and you want to see the market retaking these key levels, the 50-day being one, the 20-day being another, and the 200-day. And that's exactly what we're seeing. And then looking at market breadth today, specifically 4,400 advances, 1,800 decline is a very solid day. Great breadth, great momentum. These are the type of days you want to be invested in the market because it's an everything rally. You just take your gains and you just run with it. Now let's hop on the charts. Now, equities were very positive today. The S&P 500 and Nasdaq 100 up 0.8.7%. The winner, the IWM, mid-caps and profitable small caps, they were all up in excess of 1.5%. The RSP actually besting the large cap space, up 1%, but still underperforming smalls and mids as a whole. So really, it was a day for that broad market rotation, that value trade, as we call it on this channel. We saw growth outperform value. Yields came off their highs in a very big way. The dollar was kind of flat, but still well off the 110 area it was to kick off the end of last week. We actually just pull up the dollar. You can see we have seen quite a retreat here in the dollar, as well as quite volatile action. Look at that wick relative to where we are. That has coincided with the 10-year yield pulling back about 30 basis points from its highs. And I do think we're going to see much of the same in terms of yields. I think we're going to see yields pull back. I think we're going to see the dollar stay where it is. I think we're going to see a materially stronger dollar, especially for the first couple of quarters in 2025. And then we'll see the dollar pull back towards the end of the year. But I do think we are going to see yields pull back. And that's exactly what we saw in the first Trump term. We actually did see yields pull back after the inauguration, and the dollar actually did remain kind of flat. It did remain strong into the first 2 quarters of Trump's first year. I think we're going to see much of the same. Now, history often doesn't repeat, but it sure does rhyme. And that's what I'm thinking the trade we're going to see. We're going to see a materially stronger dollar, but yields are going to come off their highs. As a result, guys, we did see bonds gain in a very material way. It's definitely a risk-on rally because equities gained, Bitcoin gained, but we did see some momentum in gold and silver and commodities, and that was on the back of, well, a slightly weaker dollar and yields pulling back. And that generally happens when you have yields falling and a slightly weaker dollar. You do see commodities outperform. Except for crude and nat gas, there's a lot more geopolitical supply and demand with regards to crude and WTI. But let's look at the S&P 500, a bullish day, and you could see that this low right here, this capitulatory low, is really just looking like a higher low relative to this and just a continuation of this rally. For us to see this continuation, we really have to go ahead and close above the highs we made right here. We can definitely go ahead and do that. But if we zoom in, you can see that we are very clearly in positive gamma. We are making our way to the core resistance or the core wall here at 60.80. Now, if we go ahead and touch it before week's end, we probably will see a little bit of downside and this will act as resistance. But in the year end now, there's still about a 40 points for us to get there, very close to 1%. We really want to see a close above these levels. That would be very, very constructive. If the market is to pull back, we do have quite a lot of support to the downside right here. So if we do pull back, this is where you would buy the dip 59.65 area for us to continue higher, making another higher low. But market momentum looks strong. I think we're going to trade in this range and continue to go ahead and take out these all-time highs. I think the market wants to go see those all-time highs in the S&P 500. And again, upon this capitulatory low right here, guys, we closed the Trump gap up. And now it's onward and upward. Now, looking at the Nasdaq 100, we saw some very bullish momentum. Very similar to the S&P 500, we have this capitulatory low, a thrust up, and we are starting to retake some of these key levels. What we did see today was a material move higher in the core resistance, the core wall. I think that was on the back of some of the AI infrastructure news we got from Donald Trump, the semiconductors, the options market saying, hey, that's probably bullish, and the options market repricing what the Nasdaq 100 is going to do. So we have quite a bit of upside to get to the core wall. That probably means we do go higher. And again, because of where the core wall is and where we are situated, if we do get dips like we saw today, the market is going to buy those dips. That generally happens. Look at this wick. Those are buyers coming in a very strong way. And that happens when we see the core resistance move up. So you do want to be a buyer of the Nasdaq 100 here. Go ahead, take the 2185 area and look for these all-time highs. That's what we want to see. But if we go ahead and measure the all-time highs, how far we are from the Nasdaq 100, 2.5%. We are almost there. It's absolutely crazy to think of the amount of fear that was in this move lower right here, and now the optimism being priced back into the market. It's crazy how irrational markets are. But let's actually look at the RTY right now, and we're at the top end of the range. Look at this wick right here, guys. Huge buyers came in a very big way. We saw the bears try to take us lower. We bounced nearly at the gamma flip zone. We moved all the way to the core resistance zone, and this will probably move higher tomorrow. Small caps, mid caps, the RSP, things looking very, very bullish for these, because I think the market's realizing, hey, we're about to hit 44% in earnings growth this year for the Russell 2000. And if we hit those growth rates, the Russell 2000 looks very, very cheap. Now, do expect a little bit of resistance if the core resistance doesn't move up tomorrow. Nonetheless, if we break above this, the core resistance will move higher, and then we can just start taking out these stair step levels, right? Looking for new 52-week highs right here in the Russell, and then slightly above this is all-time highs. I think we're going to see all-time highs for the Russell 2000 in the first, maybe second quarter of 2025. And then the RSP looking very, very constructed. We said this is our line in the sand. We saw this capitulatory low. It broke above, And now again, like the IWM, we're just going to go ahead and take some of these key levels on the way up and then break those all-time highs at the 188 level. For those of you that don't know, I still see 200 plus in the RSP. We're currently at 182. The lowest here was probably like 173. And we're going to see 200 plus in the RSP before the end of the year. I've said that multiple times throughout all of last year, particularly in the month of December. And then looking at some of the other proxies for the market, guys, we did see the dollar come down in a very big way. This is very, very positive for some of these larger cap names. We saw yields come down as well. This is positive for the mid cap and small cap components of the market. And that's why we actually have seen, outperformance in some of these mid caps and small caps, because they do benefit from a slightly weaker dollar, slightly weaker yields, whereas yield falling doesn't really benefit the large cap names as much. So a lot of these companies are sort of self-funded. Gold was up 1.2%. I do have a 3,000 target on gold. And you can see in the last year, very, very bullish. It looks like gold just broke out. If we go ahead and draw a trend line right here, it just broke out. That's a very strong candle. We probably go and hit all-time highs at 27.89 for gold. And then we'll target the 2,800, 2,900, and then 3,000 level for gold. I had my 3,000 target for about 3 months now. Pretty much at these lows, I said we're looking at 3,000 gold. And that's going to be very, very constructive. Now, looking at Bitcoin, I think we're going to see $120,000 for Bitcoin. And we're going to follow the exact same process we have followed for the better part of the last year. And that's a rally, accumulation, rally, and then accumulation. People like Michael Saylor and most of Wall Street need to accumulate Bitcoin. That's exactly what we're seeing right now. Yes, we are hitting all-time highs in this move, but we're in the accumulation phase. Once all of these guys are done accumulating their Bitcoin, we're going to make the next move onward and upward. That'll take us to 122,000, 123, potentially as high as 130,000, but we make 122 as our first target for Bitcoin. Anyway, I am bullish on Bitcoin, risk assets, equities. You know exactly what we need to do, guys, for the S&P 500. That's retake the core resistance. That's the very first target, the 6080 level. For the Nasdaq 100, that's the 2165 area. For the RTY, we want to wait for the core resistance to move up tomorrow and then see where that repositions, and that's going to be our higher target. But off the back of my head, I would say it's going to be around here, the 2362 area, possibly as high as the 2365. Nonetheless, things looking very, very good. And if we continue to see weakness in the dollar yields, we should continue to see mid caps, S&P 400, S&P 600 outperform. And looking at sentiment, guys, we have two very key sentiment indicators, two indicators we look at almost every single week. This is Goldman Sachs US Equity Sentiment Indicator and both is Bull Bear Indicator. And both these indicators are telling us similar things, that it's probably time to start deploying capital. We see the Goldman Sachs US Equity Indicator is right here in neutral territory, right on the zero line, neither in light positioning nor stretch positioning. We're right in the middle, and this is telling us that it's probably time to start deploying capital. In a bull market, guys, you don't ever really get this. Look, this is 2022 into 2023. Only in dire economic conditions do you actually get this type of price action. In bull markets, what we are seeing right now in 2024-25, this is opportunity. Same with the BOFA Bull Bear Indicator right here at 3.8%. These indicators rarely get to the buy zone in bull markets. Generally speaking, we only get 5 to 10% garden variety dips in bull markets. This is exactly what we've seen in the last couple of weeks, and it's time to start deploying capital. And if you actually look at what the post-election year seasonality is expected to do, generally speaking, we actually put in a bottom very early in January, circa the inauguration. Then we actually go on quite a blistering rally, right? And then we actually see quite a violent pullback, which leads us to generally sideways price action in the first 4 months, the first trimester of the year. However, we are looking for a bottom in this period. We may have already had it. Either or, we are looking for a bottom for us to buy the dip to go higher into the end of the year. And this is going to be on the back of fundamentals. Right now, Q4 earnings season is looking solid. 10% earnings growth, 4.1% revenue growth, in line with expectations via revenue. However, we are beating on earnings, roughly in line with margins. And you can see 81% of companies that have reported have beaten analyst expectations, especially in earnings, and do expect this trend to continue with the big boys, financials, comm services, technology, and discretionary, all reporting double-digit mid-teens growth, and in some instances, mid-20s growth here for financials. You love to see that And the setup going into earnings season is quite robust. We had quite a number of downward revisions, and this sets us up for major outperformance, especially if we beat. The best setup into earnings season is downward revisions, gloomy sentiment. That's exactly what we're seeing right now, and that can set us up for some major earnings beats. But with regards to earnings, where does that leave us with valuation? And right now, in every single index, we are sitting at the top end of the range or above the 75th to 25th percentile. You can see it in the Nasdaq 100, the Russell 2000, and the S&P 500. We are sitting well above the historical averages, but we are somewhat inside the median range for the equal weight and the mid-cap indices. In other words, guys, if you are looking for value, look at the equal weight, look at the S&P 400 mid-cap. But the Russell 2000's valuation is reflective of the earnings growth in the next 12 months. We're looking at 44% in earnings growth for the Russell 2000 over the next 12 months. We'll see if these earnings materialize. But if this is the case, 25 times earnings is looking mighty attractive, and it might actually be on this side of the scale. Nonetheless, guys, with where S&P 500 valuations are, we're looking at the 95th to 5th percentile range. With where valuations are, the probability of a 10% correction at any point over the course of the next year is 80%. We could see an 80% chance of a 10% correction and a 49% chance of a 15% drawdown peak to trough. So guys, one thing in 2025, expect volatility. However, all dips should be bought because in bull markets, valuations rarely contract. In other words, if we do get a pullback, we're not going to see sustained contraction in valuation. We're going to see movement to the upside very, very sharply. Like we did in 2024, we are in the exact same environment here in 2025. So any dips we do get, buy the dip. And even in bull markets with very high valuations, we can still see anywhere from 9 to 9.1% estimated returns, 91% positive hit rates, and we could see minimum drawdowns of 4.4%, maximum upside of 22.2%, and that means the risk to reward for us is to stay long. However, guys, you do want to be in the mid caps, small caps, and large caps. In fact, I recommend an overweight in small caps and mid caps, neutral in large caps, and I do think you want to be positioned here in US equities. So this is in US equities. If you do that, you'll do very, very well. I think you should be underweight international equities. I don't want anything to do with emerging markets. And if you want to be in growth, value, defensives, or cyclicals, I recommend neutral in all of them. But really, small, mid, and large caps, look at the S&P 500, the S&P 400, and S&P 600. If you are in those indices, you should do very well because the macro environment is very, very solid. The Fed's GDP now sitting at 3%. You love to see that. Well above the blue chip consensus. We are smashing economic growth expectations. And this is because the fact economic surprises have beaten in a very big way. Guys, the zero line is right about here. We are at the zero line. We have seen some minor underperformance as of late. However, for the most part, we've seen positive upward economic surprises. Yes, we have seen a pullback as of late. However, the economy is very, very strong. But the truth of the matter is, guys, we know the economic environment is favorable. We always talk about the positives on this channel. Let's actually talk about some of the negatives right now. And a big negative is immigration, guys. Now, the two industries with the largest percentages of undocumented workers are in construction and agriculture, as you can see right here. In other words, stocks in these industries based on the immigration policies Trump are going to bring forth, which I am in favor of, you will see these indices get hit the hardest. At the end of the day, undocumented immigration simply means cheaper labor. These companies will now have to bring on American workers. That's positive for the economy in the long term, but we'll see very bumpy performance and very volatile performance in the short term. Another scary indicator is that the tax foundation estimates that if 60% tariffs are imposed on China and 20% on everyone else, the international market, the average tariff will increase to 17.7%. With imports making up 14% of GDP, the impact will be a jump in inflation, potentially as high as 0.5 percentage points, and that could tangibly affect the path of rates and inflation in 2024. Tariffs as well as migration is definitely two things we want to watch as we move into 2025. But guys, the big thing everybody wants to be talking about is earnings. Now, we had a pretty pretty big week here on Tuesday. However, on Wednesday, it just keeps going. Before the open, we have PG, Abbott Laboratories, Johnson & Johnson, Halliburton, GE Vernova, and Ally Bank. After the close, we have Discover Financial. That's a read-through for PayPal, a stock that I'm invested in. And that's about it after the close. So a very big day here on Wednesday. And we just keep going. We'll cover the other days in the rest of the week. In terms of data, we don't really have much of anything. We have the 30-year mortgage rate tomorrow. That's about it. Initial jobless claims on Thursday. But it really gets going here on Friday with regards to data. But if you've made it up until here, thank you so much for watching. If you liked this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.